A $799 car payment does not sound like a financial disaster anymore. That is exactly why it is dangerous. A few years ago, most people would have heard that number and said, "No way, that is too much. That is a mortgage payment." Now people hear it and say, "Well, that is just what cars cost now." And that sentence right there is how the trap begins. Because the car payment is not the real cost. It is only the number they show you first. The real cost is the payment, plus insurance, plus gas, plus maintenance, plus repairs, plus registration, plus interest, plus depreciation, plus the money you never invested because it was sitting in your driveway. So the real question is not, can you afford the car payment? The real question is, what is this car doing to your paycheck? Welcome to Malcolm Hayes Money, where your paycheck really goes. Most people do not buy cars anymore. They buy monthly payments. That is the shift. The dealership does not start by asking, what is the total cost of this vehicle over the next 7 years? They ask, what monthly payment are you comfortable with? That sounds helpful, but it quietly changes the entire decision. Because once you start thinking in monthly payments, a very expensive car can be made to look normal. A $50,000 vehicle becomes only $799 a month. A $60,000 truck becomes only $900 a month. A car that should have scared you away suddenly feels manageable because the number has been sliced into smaller pieces. But smaller pieces do not mean smaller cost. They just mean the cost is easier to swallow. And that is the entire car payment trap. Let's run the numbers. Imagine someone buys a new vehicle. Not a luxury exotic car. Not a sports car. Just a normal modern SUV or truck. The payment is $799 per month. That is already heavy. But the payment is not the transportation cost. Now add insurance. For a newer, more expensive vehicle, insurance can easily run $200 or more per month depending on the driver, state, coverage, and vehicle. Let's use $210. Now add gas. If the vehicle is a truck or SUV and the person has a normal commute, gas can easily land around $200 per month. Now add maintenance and repairs, oil changes, tires, brakes, registration, unexpected issues. These do not hit evenly every month, but they are real, so you have to average them. Call it $130 per month. Now add it up. $799 for the payment, $210 for insurance, $200 for gas, $130 for maintenance, registration, and repairs averaged out. That is $1,339 per month for transportation, not housing, not food, not investing, not building wealth, just getting from one place to another. And this is why people feel broke while driving something that looks successful. The car does not just sit in the driveway. It sits inside the paycheck. Now here is how the trap gets sold. The car is too expensive. The buyer knows it. The salesperson knows it. The lender knows it. So the system does not solve the problem by making the car cheaper. It solves the problem by stretching time. 5 years, 6 years, 7 years, sometimes even longer. An 84-month loan can make a car look affordable because it lowers the monthly payment. But it does not lower the cost. It pushes the cost deeper into your future. That is the illusion. A shorter loan might reveal the truth. If a vehicle requires a $1,200 payment on a 4-year loan, most people would say, that is insane. But stretch that same vehicle across 7 years, and the payment starts to look possible. The buyer focuses on the monthly number. The lender focuses on the interest. The dealer gets the sale. And the paycheck gets locked up for most of a decade. That is not affordability. That is delayed pressure. Let's stay with our example. A $799 payment for 84 months. That alone is more than $67,000. Before insurance, before gas, before maintenance, before repairs, before the value of the car falls. Now, include the real monthly ownership cost we estimated earlier. About $1,339 per month. Over 84 months, that is more than $112,000. That does not mean every person will spend exactly that amount. Every car is different. Every driver is different. Every insurance quote is different. But the pattern matters. A car that feels like a $799 payment can quietly become a 6-figure transportation decision. And at the end of those 7 years, what do you have? A vehicle that is older. A vehicle that has lost value. A vehicle that may need more repairs. And a bank account that spent years sending money away instead of building margin. That is the part most people never calculate. They know the payment. They do not know the total damage. The first trap is monthly payment thinking. This is the most dangerous sentence in car buying. I can afford the payment. That sentence is not enough. Because a payment can be affordable and still be a bad decision. You might afford the payment but lose the ability to save. You might afford the payment but stop investing. You might afford the payment but carry credit card debt. You might afford the payment but have no emergency fund. You might afford the payment but feel broke every month. That means the payment is not actually affordable. It is just approved. There is a difference. Approval means a lender believes you can probably send the money. Affordability means your life still works after you send it. Most people confuse those two, and the car industry benefits from that confusion. The second trap is identity. People do not just buy transportation. They buy a signal, success, hard work, status, adulthood, confidence, taste. The car becomes proof that you are doing well. That is why people defend bad car decisions so emotionally. Because when someone questions the car, it feels like they are questioning the person. But here is the truth. A car can make you look successful while quietly making you financially weaker. That is a dangerous combination. Because everyone sees the vehicle. Nobody sees the loan balance. Everyone sees the clean paint. Nobody sees the credit card carrying groceries. Everyone sees the leather seats. Nobody sees the retirement account that never got funded. Looking successful and building wealth are not the same thing. Sometimes they move in opposite directions. The third trap is negative equity. This is where the car payment trap becomes a cycle. A person buys a vehicle with a long loan. After 3 or 4 years, they want something newer. Maybe they are tired of the car. Maybe the warranty is ending. Maybe the dealership sent them an offer. Maybe they just want a fresh start. But there is a problem. They still owe more than the vehicle is worth. That gap is negative equity. So what happens? Instead of paying off the difference, they roll that old debt into the next car loan. Now they are not just financing the new vehicle. They are financing the old mistake too. And that is how people end up paying for cars they no longer drive. The loan gets bigger. The term gets longer. The payment stays painful. And the cycle repeats. This is not transportation anymore. This is financial quicksand. The more you move, the deeper you sink. The fourth trap is the phrase, I need reliable transportation. That phrase is true. People do need reliable transportation. They need to get to work. They need to pick up kids. They need to handle life. But that truth gets used to justify too much car. Reliable does not automatically mean new. Reliable does not automatically mean oversized. Reliable does not automatically mean luxury trim. Reliable does not automatically mean a payment that absorbs your financial future. The question is not, do you need a car? For many people, the answer is yes. The better question is, how much car can your financial life safely carry? Because if the car forces you to delay saving, carry debt, skip investing, or live with constant pressure, then it is not reliable transportation. It is reliable stress. The fifth trap is opportunity cost. This is the invisible cost. You do not see it on the loan paperwork. You do not see it on the dashboard. You do not see it on the monthly statement. But it is there. Every dollar going into an oversized car payment is a dollar that cannot do another job. It cannot build your emergency fund. It cannot pay down credit card debt. It cannot go into a retirement account. It cannot help you buy a house. It cannot give you options. It cannot buy back your time. Let's say someone could drive a reliable used vehicle and keep their total transportation cost $500 lower per month. $500 per month. That is $6,000 per year. That is $30,000 in 5 years before growth. If invested over a long period, that difference can become much larger. But even before investing, that $500 a month could create breathing room. It could stop the credit card cycle. It could build an emergency fund. It could make the paycheck feel less suffocating. That is why the car decision matters. It is not just about the car. It is about everything the car prevents. So what do you do instead? First, stop asking, can I afford the payment? Ask, Can I afford the total cost of ownership? That means payment, insurance, gas, maintenance, repairs, registration, interest, and depreciation. Second, decide your transportation limit before you walk into the dealership. Not after. Before. Because once you sit in the car, smell the interior, touch the screen, and hear the monthly payment, your emotions are already involved. The decision has to be made before the sales process starts. Third, avoid long loans when possible. A longer loan can lower the payment, but it can also keep you trapped longer. If the only way the car works is an 84-month loan, the car may be too expensive. Fourth, never roll negative equity into a new vehicle unless you understand exactly what you are doing. That move does not erase the old debt. It hides it inside a new one. Fifth, separate identity from transportation. A car is allowed to be nice, but it should not become the reason your financial life has no oxygen. The goal is not to drive the cheapest car possible forever. The goal is to drive a car that fits inside a larger financial system. A car that lets you live, save, invest, sleep, and build. So if you take one idea from this video, take this. The car payment is not the whole cost. It is the doorway. Once you walk through it, the real costs keep coming. Insurance, fuel, repairs, interest, depreciation, lost savings, lost investment, lost margin. That is why a normal-looking car payment can keep middle-class people broke. Not because cars are evil, not because nobody should enjoy what they drive, but because transportation becomes dangerous when it quietly takes over the paycheck. Your car should move you forward. It should not keep your financial life parked in the driveway. This channel exists to help you see those money traps clearly. Every week, we break down another decision that looks normal on the surface, but quietly shapes your future. If this video helped you see your car payment differently, subscribe to Malcolm Hayes Money. No fake luxury, no crypto hype, no confusing jargon. Just clear money breakdowns, real numbers, and practical lessons. Now you know where your car payment really goes. I will see you in the next one.